We've got some extraordinary developments going on in China. Some of the biggest, most consequential policy decisions from the Chinese central bank, as well as the Chinese government, to bail out the economic and financial system, as well as the stock market. The Chinese stock market is ripping and roaring. I am joined by Leland Miller, co-founder and CEO of the China Beige book, an analysis firm that analyzes what really goes on in China. So I am really excited. Let's get into monetary matters.
The ECB is ready to do whatever it takes to preserve the euro. And believe me, it will be enough.
Thank you. Just close the door.
Leland, great to see you. We've got over 10 policies from the Chinese central bank that are extraordinary in range and depth. And many people are attributing this to the Mario Draghi, whatever it takes, we will do to help the euro, which is actually part of the Monetary Matters intro. Your excellent report from the China Beige book is about the China's quote unquote Draghi moment. So is China ready to do whatever it takes to help the economy and markets? What are your thoughts? Because the stock market certainly seems to think so.
If the question is whether this is a Draghi moment in China, the answer is absolutely not. That is not what is going on right now. But in order to understand what's going on, you really need to dig into what they're doing and why they're doing that. And, from 30,000 feet, the real issue is that there's a growing chasm between the asset markets in China and their trajectory and the macroeconomy. And there is understandable excitement about equities right now in China for the obvious reason that they seem to have put at least a short-term put on the market. They're talking about a lot of facilities, borrowing facilities for stocks, possibly a market stabilization fund. Now, these aren't in effect yet, but they say they're coming, or they suggest that, at least that's where their policy intent is. So people are very excited. I mean, these stocks have been beaten down for years at very low valuations. There's plenty of upside to go. So you look at these things, you're like, okay, well, there's a lot of reasons to be excited, at least in the short term in the stock market. But the first thing you learn when you're doing the Chinese economy is that the stock market is historically uncorrelated to the real economy. The stock market peaked in 2007. Since it's gone down, GDP's gone up by over 500%. They've gone in opposite directions. They are not correlated. So when you look at the stock market, you can get excited about what's going on, but that doesn't mean anything. It doesn't tell you about conditions on the ground. It doesn't tell you about the conditions of the real economy. And so in order to understand that, you really have to go step by step. And the big components of this are credit, it's property, and it's equities. You have to go step by step and say, what are they doing right now? What's their intent? And what's likely going to happen outside the next couple of weeks to cause or not cause a pivot in sentiment in China?
And so let's go into the measures. There's cutting interest rates, 3 interest rates, I believe, the reverse, the repo rate, the main lending facility, the loan prime rate. There's cutting the reserve requirement ratio by 50 basis points, which quote unquote will unleash $1 trillion in liquidity, as well as the $500 billion of yuan in liquidity support for the stock market that you just mentioned, as well as a hazy promise to do a stock stabilization fund. People's Bank of China, Governor Pen Gongshang, so the Jay Powell of China, gave a speech where he outlined these measures. How successful do you think these will be in stabilizing? Let's do first the stock market, then the real estate market, and then the broader economy. And so which do you think it will be the most effective at helping, and why?
I think the biggest point about credit, and this is a hugely fun topic to talk about, because China Beige Book has tracked interest rates paid in China from thousands and thousands and thousands and thousands of firms for almost 15 years now. So we know when interest rates are going up and down, and we know what the reaction is to that. And what we can say here is that since the beginning of 2023, you have seen a collapse in interest rates, despite the fact that you've had high interest rates around the world and inflation around the world. In China, interest rates have been going down, down, down. First quarter, they dropped precipitously. Of 2023, they stayed low throughout 2023. They dropped again in the fourth quarter of 2023. When in 2024, they dropped again. Then they dropped again. We just saw the lowest level of interest rates we've ever seen in the history of our survey recently in this past month. So rates have been going down. Monetary easing has been happening. there's not an appreciation of this because there's this idea that there's a benchmark interest rate out there. Maybe it's the loan prime rate. Maybe it's some sort of medium term rate. None of those are benchmark rates because they don't correlate to what we're seeing in terms of what corporates are reporting and in terms of cost of capital. Cost of capital has been going down for the last almost 2 years in China. And guess what's happened? Nothing. We are not seeing any pickup in borrowing whatsoever. I mean, none at all. We're still at all-time lows in borrowing. We just dropped further. So September is fascinating because it was the lowest interest rates we've ever seen, and it was the lowest levels of borrowing tied with one other time that we've ever seen. And the takeaway from this is that cutting rates is not going to cut it. Firms are not looking for cheaper cost of capital. They're not waiting out to see if there's another few bips off their borrowing rate so that they could finally jump in. There's a problem is confidence. The problem is sentiment, corporate sentiment, investor sentiment, et cetera. And so in order for monetary easing to have an effect, you have to have a broader change in sentiment. You have to be convincing firms the conditions on the ground and their future as they walk towards that horizon is going to get better. Like the sentiment has to change overnight for firms to want to borrow more. Because look, if you take an RR cut, does this talk about, we're going to have a 50 basis point RR cut here and you have another one there. You're freeing up liquidity to lend. That's what an RR cut is. You're telling a bank that you're freeing up liquidity to lend. If firms don't want to borrow, an RR cut doesn't do anything. So in order for there to be a turnaround, you have to have much stronger loan demand. And what we have seen now for several years is that cheaper rates have not had any reaction and any response in terms of borrowing. So in order for you to think that these credit moves are systemically and structurally important, you have to believe that there is such a sentiment change in the macroeconomy, again, not stocks, that firms are going to say, well, wait a second, life is good now, let's go borrow. And we don't think that's going to happen.
And that's such a good point that just because there are low interest rates, that doesn't mean that a lot of borrowing is happening. That happens if there are a lot of people who want to borrow. But as you say, there is not a high demand of borrowing in China because people, investors, real estate developers, and consumers are not that optimistic about the economy. So much of this hinges upon real estate. Do you think that China is going to assist the real estate market and try and boost consumption? I mean, aren't they lending to local governments to buy unfinished homes, which really is quite an extraordinary policy to me, at least.
Yeah, I was listening very carefully to the way you crafted the question, because if the question is, are they going to support property? The answer is yes. I think they made it very clear they're going to support property because they want to stabilize it and they want to stabilize expectations. The answer, are they going to create an upward stretching? Are they going to cause a property recovery, a meaningful property recovery? The answer is no. And the reason they're not going to do this is because Xi Jinping doesn't want a meaningful property recovery. The reason that Xi Jinping started, the property deleveraging, was that property was this black hole where credit just disappeared into for years and years and years and years and years. And property had become 25% of the economy. It was a major growth driver. And there was a decision at the very top, which was made very clear with the 3 red lines back in 2020. And then the Evergrande implosion. Evergrande was allowed to implode, and then Country Garden, et cetera, is that property needed to be deleveraged in order to minimize vulnerabilities in the economy and therefore to the party. So property has been frowned upon. Credit has been dwindling to property. I mean, we're not just guessing on that. We can actually track credit flows into property, and we've watched as firms have been strangled from banks, from shadow banks, et cetera, for years now. So the entire intent of what Beijing has been trying to do for years now is force painful medicine on the property sector. Yes, it's been tough sledding, but what they have been trying to do is make property less important and less of a growth driver. So you're deflating that bubble and you're creating less potential pockets of instability in your economic growth model. So the idea that they're going to step in now, it makes sense. Now, keep in mind, they have stepped in little baby ways for years now. We can actually track in our data where we see firms, deleveraging, tighter credit, less borrowing, et cetera, which essentially was culling the herd. This is the way we described it. We say it's culling the herd, try to take out the weak firms, all these zombies that have existed on just endless credit. And then when you get to the point in the property sector where cash flow was freezing up, where the strong firms in there were starting to feel pain, when you looked like contagion was potentially going to spread outside property, then the government would step in, and we could see it in our credit data. They would ventilate. They would allow some credit to the sector. The cash flow would ease up. But guess what? Every time they went back to the deleveraging. So you'd see deleveraging, tighten, exhale, tighten, exhale. What they're doing right now is just a much bigger exhale. And I think they needed that because the challenge for the Chinese leadership is that they are looking down a multi-year path. That's just an impossible challenge, which is how do you deflate the property bubble? How do you bring costs down over time consistently without creating a doom confidence loop where people say, wait a second, 70% of household assets, roughly Chinese household assets are in property. They're seeing their values go down. They don't want to buy. It's going to, they have less money, so they don't want to spend more. And you have the risk of having a contagion come from what is a very well-meaning property deleveraging campaign, which means you have to regularly step in and show, look, there is government support. We're not going to let this ride. We're trying to deflate the thing, but we're not completely standing off to the side on this. This is a time in which they looked at economic conditions, which have been bad. They look at the stock market, which has been terrible. They looked at the property market, which had gotten to a point where things were really dropping even more than they thought. Confidence had sort of gone to a new low, and they needed to step in with something bigger. So stepping in with a program to backstop local governments, to help unfinished homes get finished, all that makes sense. The idea that they're going to juice the property market back, that they're going to cause some sort of more significant recovery, that's not going to happen because they don't want it to happen.
Thank you. And Leland, for our audience, a byproduct of China's extraordinary growth has been the biggest real estate bubble in history, bigger than the U.S. subprime bubble of the mid 2000s. And unlike in the U.S., it was individuals who were getting over leveraged to borrow money they couldn't afford to pay back to buy their own homes. In China, all the leverage, or a lot of the leverage, I should say, is in the developers. And so you had Evergrande, Country Garden. Evergrande, I think, had $300 billion worth of liabilities of loans. They folded. They went bankrupt. Country Garden too. And this has been something of a man-made implosion by the Chinese Communist Party. It is not a market panic as you can typically understand it. You referenced the three red lines, that being the rules passed by the CCP, Chinese Communist Party, in I think the summer of 2020 about how much firms could borrow and their debt to equity and status like that. So are you saying that the property prices will stop going down, but don't expect them to go up again suddenly? So why do you say that's the case? And if it is, what are the implications on the macroeconomy? I assume if prices were allowed to continue to decline, you would have a negative wealth effect, deflationary scenario where everyone's assets are going down and there's deflation. So confidence is just abysmal, and a vicious recessionary cycle feeds on itself. What are the consequences if prices are no longer allowed to go down, but they don't go up miraculously? They just sort of stay where they are.
Well, they'll continue to go down. They're just not going to go down right away. So the idea here is if you're trying to deleverage the property sector from being 25% of your economy to something much, much lower, let's say 10%, just throw that number out there, then you need to make prices go down for years and years and years. But if prices just go straight down, people look at their investments and they say, wait a second, I got to get out before they're lower. They see this race to zero, and it can create this doom confidence loop. So what they're saying basically is, no, we're here. We're not going to let that happen. Everything's going to be controlled. We're stage managing this. And it doesn't mean that they step in and they're setting in a turtle floor on property prices. What they're doing is saying, look, we're going to step in here. We're going to provide support. The government has allowed this deleveraging. It's encouraged in a lot of ways this deleveraging. But what we're going to do is going to set this floor so that certain things are getting taken care of. There's policy support going to some of the priority areas, like these pre-sold homes that never got built. And some other local government obligations. And so we're going to step in and be active and be involved. That doesn't mean that they've set a floor and now things are bouncing up. It means they're trying to control the slide. And it's an impossible task, because anybody looking at this who knows where they started and where they're going understands their trajectory and is going to be incentivized to sell. The one thing working for them, of course, is that in China, it's a closed capital account. You have a limited number of investment options. So the idea of going into equities right now is probably pretty good, but you don't always have this beautiful option. You can't diversify very well. You can't send your money abroad legally, and so really, a lot of this money is kept inside China. It goes to property because it was the least worst thing. But now they have to make sure they restore some measure of confidence, because it was really having a spiraling effect on the economy and consumer sentiment.
And Leland, how big of a deal is China's support? I think at $71 billion, half a trillion yuan liquidity facility to support stocks and to have a swap facility where funds can borrow money to buy stocks. In the U.S., that does not exist. That people cannot borrow from the Federal Reserve to buy stocks. As you pointed out earlier, the Chinese stock market is way less important to China than the U.S. stock market is in China. The asset class of choice is real estate. Why then is China and the Chinese Communist Party, the People's Bank of China, putting such an emphasis on supporting, or at least appearing to support, the stock market? Why are they making loans to the stock market? Why are they insisting or basically encouraging funds to buy stocks, as well as stocks to buy back their own stocks, companies to buy back their own stock, which is very bullish for those companies? It appears that China does have an interest in keeping the stock market going up, right?
Well, look, I don't think Xi Jinping cares about the stock market, but they went overboard intentionally this time because the previous measures didn't work. I mean, this isn't like the first time that Beijing decided to jump in and try to have a market intervention in the stock market. National team has been buying all year long, and what's been happening is that's been giving just enough room for people to sell into strength and get out. And they saw it was happening. It's happened over and over and over. I don't know how many times this year we talked to people in the markets and clients, and they said, "Don't you think this is a great time to go in? These low valuations." Say, what's your thesis? What government policy do you think is going to spur this? So the idea here is not they're breaking the seal on intervention. They have been intervening for a long time. They needed to do it in a bigger way to show we're bringing out bigger guns. So I think when you're talking about the stock market, this is bigger bang than they've been doing, and it's intentional so that they show they mean it. It's not going to be a flash in the pan. You're not going to get a 3-day stock surge, and then it's going to go back down the next 4. So they needed to show they meant business on equities. And again, equities are not important in the grand scheme of things, but their performance was so poor, and there's so much wealth lost in them that it had the effect of just further crushing sentiment, which was already low for the consumer. It was already low for corporates, and they just had to get out of this doom loop. I think what they thought was happening was they'd begun to enter this doom loop that we've been talking about for the last 18 months, and they needed to get out of it quick.
And so, as you probably saw, billionaire hedge fund manager David Tepper went on another financial program and said he was incredibly bullish China. He really liked the policy support. He thought the companies were cheap, and he was breaking his own family office's risk limits in order to grab as many Chinese stocks as he could get his hands off, through individual stocks, through futures, indices, ETFs, everything. It sounds like you disagree with David Tepper.
No, look, if people want to be, hysterically excited about stocks in the short term, the government is saying we're behind you. So that's a very strong signal. So but again, we have to differentiate between asset markets and the macroeconomy. So what is the government message on the stock market? This government message is it's gone down too much. We want you to get back in it, and we are going to actually help you, or at least we're suggesting that help is on the way for us to, create facilities for you to borrow more to buy into the stock market. We're going to have national team buying. We have this market stabilization fund. It looks like the wind is at your back. So in terms of a trade, it's a very good one in the short term. Now, what is short term? Historically, it's been under 2 months. So a lot of people think that this is the return of the Chinese stock market. I think that if we talk in early next year, I think we may be in a very different position. But in any case, we're talking short term. We're talking the trade. We're talking asset markets. There's a lot of reason, because the signal from Beijing is matching up with what investors are hearing, which is go and buy some stocks, at least for right now. That's not that's not what's happening in the real economy. The message people are hearing is, oh, stocks are great, lots of stimulus coming, stimulus, things are going to get better. But what the government wants in the real economy is stabilization. They want to make sure they're putting a floor on growth. When we became China watchers 5, 10, 15, 25 years ago, the rule was that, the Chinese leadership wanted high levels of growth. Chinese Communist Party needed high levels of growth. They didn't like to see weak data. If they saw weak data, they'd stimulate to that weak data. And you were always going to see a strong performance because that was what justified, the one party Communist Party rule. It was that we look at all these high levels of growth that we're delivering and we're making you rich. That is not what has been happening. The paradigm completely shifted a number of years ago. You saw it with the Common Prosperity Campaign. You saw it with the Three Red Lines campaign. But right now, if you got into Xi Jinping's mind to the extent it's possible, he's much more worried about national security priorities right now. He wants to build a domestic chip ecosystem. He wants China to be competitive on advanced technology. He wants to minimize reliance to the extent it's possible on US dollar payment systems because he's worried about sanctions. They want more supply chain resiliency. There's all these things that are really existential worries in Xi Jinping's mind that have nothing to do with growth, which is why it's very funny to see all these, headlines of talking about, oh, Xi Jinping worried about GDP growth target. Xi Jinping is not worried about the GDP growth target. It's a symptom of the fact that if they're so far off that they can't lie about being close to it, then it probably signals that there's an issue there, and they got to make sure that they're doing enough to set a floor so that they're not going to have this doom loop of confidence, so they can set their mind worrying about other things, which are these national security priorities I just laid out.
And Leland, in an interview that you and I did on my previous show in Forward Guidance in 2023, you said that even though you were a secular doubter of China's ability to transition to a consumption-driven growth model and maintain its high level of 8% or even higher growth, that in the short term, 1 to 2 years, you didn't think there would be a huge economic crisis in China. I think you've been right that real estate prices have gone down, nominal growth has gone down, there's been deflation, so real growth has actually been quite good. The unemployment rate, as I believe stopped to be reported. But how would you assess China's current economic picture now? There's a big spectrum. If you work for the Chinese Communist Party, you probably say it's fantastic. If you are a commentator and economist, you say it's horrible. Where are you? How do you assess the strength of the Chinese economy? Let's say in a cyclical 1 to 2 year growth. We'll get to your secular view later.
Sure. So I've got a surprise for everyone. The economy is not as bad as the newspapers are telling you, as the blogs and the Twitter are telling you. China's economy is not that bad. It's not doing well. It's actually been very weak. And the last few results we've got, September data in particular, was very, very weak. So the economy is not in great shape. But it's also not collapsing. It's not in crisis. It's not falling apart. And so a lot of the people who have talked about this ridiculous Draghi moment thing have premised their understanding of China on the idea that China has just come to a cliff and is either falling off it or already fell off it or something. That's not what the data say. If you look at what's happening, it's the economy's weak. They're not investing as much. The borrowing is a real problem because no one wants to borrow. But the labor market's not falling apart. Investment's not falling off a cliff. It's none of this stuff is good, but it's not terrible. So you have to really have a different view than this bipolar view that you usually get on the blogs or you get on Twitter, which is either China's doing really, really well, or it's about a day away from collapse. The answer is usually in the middle, and this is what we've been explaining. Our data are poor. China's weak, but it's not catastrophically weak. So the reason for doing this was not to bail China out from cataclysm. It was to stop the potential doom loop of confidence, which I think they thought was about to happen or starting or whatever it might be. It was about sentiment. So if you're under the understanding that the economy is not nearly as weak as it's being made out to be, at least this week, then you're able to look at things and say, well, they're confident with slower growth. they're willing to deal with some of these lower numbers, so long as it doesn't gum up the whole system. So I think cyclically, what we're seeing is an economy structurally. You know where I'm going. They're slowing down dramatically over time. Cyclically, things are not good, and they're looking worse, but they're not terrible.
Right, right. And in China, you have better, more granular data on this, but what's the reported data is retail sales year over year for August were up 2.1%. Over the same time period, they've had almost no inflation. Let's call it 0% inflation. So real retail sales are at 2.1%. That doesn't sound horrible. It's definitely a period of lower growth than China has been used to. So if you compare it to the 8%, 10% growth of the mid 2000s, of course it's bad, but it's not a recession. Okay, so that's an interesting take. You're saying that China's economy is not as bad as some people say, because Leland, I think you're known for being a critic of the Chinese investment-led or real estate level led growth model, and so you for a while have been criticizing that model, and I guess. How is it that China's economy has slowed but has not entered a depression while its real estate bubble market has imploded? Because normally, if you have a Chinese real estate bubble, if you have a real estate bubble or an asset bubble and it implodes, it causes a recession. The Great Depression, 2008. Japan, 1991. Let's actually compare that. My last forward guidance interview, my old show with Richard Koo, he accurately diagnosed the Japanese real estate bubble as a balance sheet recession, one where a bubble implodes and low interest rates are not effective at stimulating the economy because there's a lack of borrowers because they're paying down debts rather than maximizing profits. That sounds a lot, Leland, like what you were talking about in the beginning, how you don't think the low interest rates in China are going to be stimulative. So I guess how is it the case that the economy isn't that bad when you have a huge real estate bubble bursting?
Well, because China has a non-commercial financial system. All the people who were predicting a Lehman moment in China were wrong before they even uttered it out of their mouth, because China doesn't work the same way that Western economies do. It's a non-commercial financial system, which means when you get into a pickle, liquidities you don't let liquidity freeze out because the state controls all the counterparties. You can order lenders to lend. You can order borrowers to borrow, suppliers to supply. You can make sure commerce doesn't completely slow down, and you can also take huge swaths of capital from one side of the system and use it to bail out other parts of the system. So think of a creaky ship bursting holes. You just sort of keep running to one side and plugging up the hole. Then you go to the other side, plug up the hole. You can do that in a non-commercial financial system in a way you can't with a commercial financial system. Now, but the downside to this, of course, is that you slow down precipitously over time. More and more of your capital is going to end up going to non-productive uses. So, you're growing at 8%, then you're growing at 6%, then you're growing at 5%, you're going for 3%. You can continue to keep things alive. You keep the zombies alive. You can continue to plug up holes, make sure people don't default or don't go bankrupt. But what you're essentially doing is throwing capital at these things that should be used for productive uses. Instead, you're using them for non-productive uses like bad debt. And as a result, the economy continues to slow dramatically over time. Now, this is something we were talking about back in 2012 when we were just getting off the hill of the loan binge of the great financial crisis. We say, look, China is going to slow down dramatically. And we actually had to temper our message for about 5 years, because we would go into corporate boardrooms and explain what's going to happen. And the CEO's like, I don't believe you. All my guys in China say that they're going to grow at 8% forever. And maybe they slow down to 7.5, but this will work forever. So no, this is a long-term substantial slowdown. And it's way, way more significant than what anyone's, understands is coming. And so then you get a couple of years later, and all of a sudden you hit 6%, and all the doom scenarios of, China had to grow. You remember there was a thing, you had to grow at 8% or you couldn't employ everybody who was coming out of college, or China was going to collapse at 6%, and then 6% was okay. And then 5% and then 4%. They realized that China can continue to slow down, particularly with its populations falling so gradually. And it's not great for China, but China's not going to implode. It just means that you're going to have a slower China. If they do it right, it'll be slower, healthier growth. If they don't, it'll be a mess and slower growth. But either way, the China economy is slowing down massively over time, and we're already seeing that.
And has been growing faster to counterbalance the collapse in the real estate market and the real estate sector is, I guess, high value exports, electric vehicles, additive manufacturing, 3D printing. I know that's kind of, not a giant market, but you think of the excellence of BYD, just how much they're growing. I think they've made 7 million electric vehicles so far, and they're exporting those around the world. Is it true, Leland, that China is directing bank credit and financing to all types of export driven or manufacturing driven sectors other than real estate? So they're starving the real estate sector of credit that has taken the credit for so long, and they're giving it to every other industry or many other industries that are not real estate to offset that. Is that a fair picture, or am I wrong?
No, broadly speaking, you're right. I mean, they are taking the credit that they used to allow to swim into the black hole that is property, and now they are directing into advanced technology and high value manufacturing. So yeah, that's happened. Overall, credit's slowing down. But yes, what you used to have is that you just have credit dispersed all over the place to anybody who needed, essentially, and because you wanted to create enough growth, even if it was non-productive growth, to hit these GDP targets. And so maybe you'd go organically grow 5%, and you need 1 and 8% targets. So then you'd open up the spigots, allow more credit to go, produce more, and you hit 8%. That 3% is not productive growth, but it went usually to property, so that you spurred a higher GDP growth number. That's gone now. So now with credit a lot tighter than it was before, they've taken away that spigot for property, and one of the few places it's still allowed a lot of credit are these specific areas. Maybe not broad manufacturing, but certainly niche areas of manufacturing, like the EVs, like semiconductors, like other things that they think they need in order to compete in the fourth industrial revolution, which Xi Jinping has said is their goal. They want to dominate advanced technologies. If you are an advanced technology, then you're a national security priority, which means you get the credit. If you're not a national security priority, you don't get the credit anymore. I think that's the difference between China today and China, 5-10 years ago.
And tell us about what's going on with the delinquencies in Chinese credit markets.
Look, it's a problem. If you look at what's happening with M1, it's M1 is falling off a cliff in China. So, I could talk about positive things we see in our data. One of the negative things is that M1 has slowed down so dramatically, in the past several months and years. And so, look, at this point right now, the consumer looked forward and it was gloomy. The investor looked forward, it was gloomy. The household looked forward, it was gloomy. And so because of all these three things happening at once, this is why you saw the latest stimulus package. They wanted to arrest this, show that the government's still in charge. But you got to come back to the idea that what happens in equities is not what happens in the real economy. And so we need to be very, very careful in evaluating what the takeaways here are for stocks versus, growth, sectoral growth, GDP growth going forward.
And so I don't think you think China is in a recession now. Do you think they are headed for one?
Let's talk about consumption for a second, because like what had just happened here, and there was rumors all year that they were going to do a bigger consumption one-off. So they haven't laid out what exactly they're going to do. They sort of talked about devoting some of this bond issuance to giving some money, some cash handouts, some other things supporting the consumer and subsidies, and this will be good. This will boost growth in the short term. I mean, you get someone gives you money, in this situation, and you're to spend some of it, and so it'll be helpful. But the reason that this isn't as big a deal as so many people are making it out to be is that this is not going to change the mind long term of the Chinese household in terms of consumption. Consumption in China is structurally disincentivized. Everything is empowers the state. Interest rates empower the state. Savings, but historically, the loser has always been the consumer, been the household, been the private firm. And I don't think any of this is going to change. If you look what's in Xi Jinping's heart of heart, he'll do this one-time handout. But does this mean that they're going to shift the economy more towards, empowering the consumer? Are they going to, appreciate the currency to put more purchasing power in the pockets of households? Are they going to, materially change the social safety net in a huge way? Are they going to transfer state assets to the private sector, to households in order to make them richer? I think we're seeing mostly things going in the other direction. So I think we've got to be very careful. A lot of the stimulus, you're throwing money in the economy. You can have a short-term boost. You'll have it affect. Some of the stuff will hit in 2025 if they keep it up and they do all of what they say they're going to do, which is not a guarantee. But the reality is that this isn't going to change the mind of the Chinese consumer by giving him a one-off. What he wants to see he wants to be empowered, and at the opposite's happening in China. I don't think this changing anything. So this is again a reason to be very hesitant to thinking that today's stimulus package is going to have any impact beyond sometime next year.
Is it fair to say, Leland, that the Chinese government has been very reticent to do fiscal support, such as sending people money, which is what the U.S. government did in 2020? Obviously, we have Social Security for elderly people. We have welfare programs for low-income people. That China, even though is called a communist country and America is a capitalist country, it kind of is the reverse of what you think, in that there's more support for citizens, direct fiscal support in the U.S. than there is in China. Tell us, what is the proposed or rumored fiscal support in China? Is it sending people money? Is it direct fiscal support? Is it only to low income, or is it to low and middle income, or is it to everyone? Tell us what's rumored and what do you think is actually going to happen?
Well, the problem is we don't know. I mean, so some of the rumors say they're going to hand out cash to people with particularly low incomes. They're going to have subsidies. They're going to hand out subsidies to other things. People who have kids are going to get some sort of one-time payment. Look, which actually doesn't make a lot of sense. What China needs right now is to be paying people to have babies, not to maintain them. But in any case, I don't think they've spelled this out. I mean, if they really had this plan, they would have had more specificity around it. We haven't seen that specificity. It doesn't mean there's not going to be some oomph on this. They seem to want to have oomph, but again, it's a one-off. They're not structurally changing, the way they manage consumption in China. They're simply creating they're pulling growth forward. That's what they're doing. So if you give people money you haven't spent earlier, they're pulling growth forward, which means this will help in the short term. It'll probably be medium-term negative unless they do more of it. But again, the rumor has always been that Xi Jinping really didn't like any of this consumer stimulus, this demand-side stimulus. Obviously, his mind has been changed, at least for this one time. We'll see whether he's made any long-term pivots, but I don't see any evidence of that yet. The other thing is that, in China, with the growth slowing, with all these problems with bad debt, and, you have less credit to throw around. And if you're really worried about building up a domestic chip ecosystem, I mean, you're throwing hundreds of billions of dollars towards semiconductor firms, so they're going to be able to create technologies to lessen or eliminate their reliance on Western technology, the export of which is being stymied by some export controls. So he's worried about that. They don't want to be vulnerable to U.S. sanctions. If you're doing that, you can't turn around and still have cash to throw at consumers all the time, and you got to pick your priorities. His priorities are absolutely clearly on the national security side. It doesn't mean he won't step in, because they just did in some ways, one off, send a signal, try to put a floor on sentiment. But we should be very, very cautious about reading more into it than it actually is.
And so many people are referring to the slew of stimulus packets from the Chinese government, as well as the Chinese People Bank of China, as a bazooka. So do you think it's a bazooka?
Well, you can argue terminology around what's happening at the stock market. If they do everything they're saying they're doing, then we won't quibble with bazooka on asset markets. I mean, it's how long the put exists and how intense it is. So let's leave stocks out of here. Outside of stocks, no, this is not a bazooka. This is they're throwing some numbers around. We don't know what the actual bond issuance is going to be. We don't know what, a lot of the time they have these programs and they don't even use up their quotas for lending out. So how are these things to be lent out? Are we going to create? Is Beijing going to create facilities where people could borrow to go buy some property that they don't want? I mean, is that going to do anything? Are people going to borrow that money in order to invest in this property sector, which has been frowned on for the last 3-4 years? So we just don't know what this is going to end up being. But I think we could be pretty confident in concluding that at this point, it doesn't look at all like a bazooka, certainly outside of asset markets.
And so, Leland, there's a term I want to introduce to our audience, which is called a trial balloon, when an authority announces an idea to the press, and then they see how people and market participants react to it. An example would be the Federal Reserve would say, we might do a little 50 basis points, and then they see how the market reacts to it, and then they act accordingly. Washington, D.C., politics works in a similar way. I think perhaps we are in this stage in Chinese stimulus where the People's Bank of China has actually done a series of programs, cut interest rates, cut the reserve requirements. But in terms of the government, they're just announcing a few trial balloons and seeing what the reaction is. Do you think that's a fair way to characterize it? And is it different because Chinese government is an authoritarian one that does not require consensus or a majority, unlike Congress?
I think it's a very charitable way of describing it. I mean, I don't think that they're sifting around. They've got these ideas and they're sniffing around for popular sentiment on it. I think that they don't know what they want to do yet, and they want to make sure they're conveying the idea that this is going to be powerful, but they don't really know how they're going to do it. And it obviously developed fast enough that they didn't have everything ready to go when they made the announcement. So it suggests there was some measure of panic and urgency around this. But look, the other thing that happens is regularly when Chinese policies are announced, they're announced and then they never happen. I mean, I remember that there was a Bloomberg article, we used to joke about this, that talked about 5 trillion yuan of stimulus that was about to go in the economy in 2022. I mean, you can just Google, I think you could probably get it by just Googling 5 trillion yuan China Bloomberg or something. And there was about to be unleashed. Did we see big stimulus in 2022? No, we saw the exact opposite. We saw everybody screaming, why are they not stimulating? But they announce these things and then people take them seriously. So I'm not saying that a lot of this isn't going to come to fruition. I think a lot of it will at least. But it's a regular part of sort of Chinese policy rhetoric to announce a program, then maybe not do it. The next time you announce stimulus, to re-announce the same program, include that number in your own program. It's been happening for years. It's why people thought there was so much more fiscal stimulus coursing into the economy during a time where the end of last decade, when China was actually weaning off that as a stimulus measure. But they would announce these things and markets would take them seriously. And we have a fiscal activity index. We're looking at this, scratching our head saying, nothing's happening. What are people talking about? They'd announce these programs, they wouldn't do anything, but we'd still get, questions from various people saying, well, wait a second, we heard they just did a trillion yuan bond this and a trillion yuan bond that. And so, none of it was actually happening. So we got to be very careful at, seeing the walk versus the talk.
Yes. And in your excellent report from the China Beige book, you talked about the 3 interest rates that were cut, as well as the reserve requirement ratio, and that has actually happened. A lot of the other stuff is either a rumor or it's going to happen but hasn't happened yet, and that is definitely in the trial balloon phase. And Leland, I know you have a view that you actually admire what China did to the real estate market in terms of allowing the large real estate developers to fail rather than bailing them out. Tell us why you think it was a good thing that Evergrande was allowed to fail and that China didn't bail them out like the United States did with, for example, Citigroup or AIG. Why is that a good thing?
I'm quite critical on a lot of the things that Chinese leadership does. But in terms of property, I think some of it's misunderstood. We very much disagree with this consensus opinion that, and you see it in the Wall Street Journal and Financial Times. Our friends write about it in the media. This idea that China built, and now the model's collapsing, and it's all chaos in property, and it's the whole system's falling, and that shows that the ultimate lesson was communism could never survive. That may be true about communism, but what's happening in property is something very different. They looked at the property sector and the enormous amounts of credit that have been going in, and they said, this is a problem. This is not helpful growth. It's not productive growth. It's causing bad debt, but it's also steering credit into places we don't want it to. We need to really steer it towards priority sectors like advanced technology. We've got way too much going to property. We need to deflate this property bubble. And so what you've seen over time is they warned over it. They warned this. They gave the 3 red lines. People that still didn't think there was going to be a change, and then they let their gray rhinos, like Evergrande, like Country Garden, implode because they saw the problem there and they needed to cause havoc. And everyone said, well, why don't they step in? Why don't they step in? They don't want to step in. We're engineering this. Now, I'm not saying it's some sort of beautiful engineering, but it's a controlled demolition because of the problems that they had. They wanted to make sure that they were eliminating these vulnerabilities from the property sector, and that started with the biggest, most dangerous credit beasts, which were the gray rhinos, these giant shadow banks. And so you've seen them just implode one by one. It was never a threat to the Chinese system. It was never a threat to the Chinese financial system. Non-commercial financial systems allow them, like China's, allow them to control this. But it was a mess, and it did cause a problem with sentiment, and it did cause a problem because 70% of household assets are in property, and so you're seeing property values go down. Enormous challenge. And what has been impressive about what they've done in property is that they haven't stopped. So they didn't feel pain. This is what you used to see all the time in Chinese, quote unquote, reform efforts. They do something, it causes a little pain, and then they back off. Then maybe a couple of years later, they do something, they cause pain, they back off. They haven't backed off this property stuff. And I think people may interpret what's happening right now as backing off. Certainly Draghi moment people do, but that's not what's happening in property. They're going to step in, they're going to stabilize it, but they've been willing to take enormous pain. And the idea that they have undergone 4 to 6 years of massive, painful medicine, in deflating the property bubble, and then all of a sudden Xi Jinping woke up, got some whispers from his advisor last week, and decided to end all that and reverse it. I think the notion's rather ridiculous. So what they've been doing in property is impressive in that they've been willing to take pain. And then, like every other time in modern Chinese history, when the economy felt pain, they didn't pull back and reverse themselves. They kept going and kept going and kept going with just occasional bursts of support along the way.
Do you think there will be more large-scale bankruptcies of real estate developers? And are you a bull on on Chinese property bonds, which are trading at very distressed valuations? I am looking at a basket of Chinese property bonds right now, which I will not mention for our viewers the name of, but it's got property companies Yanlord, Guangzhou, Longfor, Dalian, Jinmao, all these developers that have not gone bankrupt yet, but their bonds are trading at very distressed valuations. Do you think they will be paid off and everything will be fine? Or do you think there will be a lot more bankruptcies and maybe that is not a place to go dumpster diving?
I wouldn't go anywhere near it. But look, I mean, I'm not saying that distressed debt investors can't go in there, buy something for 13 cents, see it go up to 18 cents, sell, and make a nice chunk of change. I mean, we've worked with distressed debt investors, but we're not telling them to buy here and not to buy there. What we're saying is, here's structurally what's happening in the property sector. Here's government policy as reflected by credit flows, and so we can tell you if this stuff is in better shape or in worse shape in terms of government policy as reflected by credit flows. So we're able to look into this and sort of see the lay of the land. But the idea of dumpster diving in this is for a very sophisticated, specific type of investor. We want nothing to do with it.
Got it. And what about the banks, which have made a lot of loans to real estate firms, and in a capitalist economy would be in a lot of trouble because they've made loans to real estate firms that are now bust? Perhaps in a communist economy, it's slightly different, or in an authoritarian government, it's slightly different. I see rumors, and again, important to say that rumors about China, quote unquote, injecting $142 billion of capital into the top banks. That sounds like a lot of money, and it is, but it's pales in comparison to the size of the bank. So it's a tiny fraction of the Chinese banking system. And interestingly, even though the Chinese stock market is up today, most Chinese banks are actually down, which to me is interesting. What do you think about the Chinese banks by themselves? And then, do you think there's a systemic risk because of all these bad loans in the banks?
Look, to understand the banking system, you have to understand the concept of the blob. Now, all the stimulus stuff that's how we tweet about this a lot, so I think you know what I'm talking about. But all these stimulus measures, cutting rates and stuff, you have losers in this. Who's losing? Well, the profitability of banks is the loser. So these banks are getting taken out to dry by the fact that the government keeps ordering them to lower rates and lend out at lower credit costs. So then the banks get in big trouble, and the government comes in behind them and infuses them with something, and then you start the cycle again. But the concept of the blob is, in China, everything ultimately has to be backed up by the government. Implicitly, explicitly, something. Now, they can't bail out everything at once. But the idea here is that if you have a one-party system, then you can't have your economy go down. So you can't have massive job losses. You can't have massive bankruptcies. You can't have massive, economic crises. You're going to have to step in. And so you're going to, one, you control the counterparties, and in this non-commercial financial system, you can order them to do a bunch of stuff. But ultimately, all the liabilities in the economy are ultimately backstopped by the government. Now, the government has to convince these arms, these local governments, et cetera, that they're not going to backstop them. That's why you see years and years of back and forth saying, get your finances in order. No more local government finance and vehicle, lending. Keep within leverage limits. No more lending out to property. No lending out the back door to shadow banks. So they have to make sure they're playing the game in terms of telling them to be fiscally responsible. But ultimately, when these things get in trouble and look like they're going to go down, the government has to step in and get them. And it's just the blob gobbling them up. It's going to gobble up that liability. So everything in the entire economy is ultimately backstopped by the blob. If it all happens at once, it's a problem. If not, it's a long game in which Beijing's basically telling everybody, hey, take care of this yourself. But if they don't take care of it, they're going to have no choice but to go in and gobble it up. And so this is why it's very clear China is not just slowing down over time. It's going to slow down enormously over time, just almost to grinding halt, because they have to backstop everything. And every time they do, they're sending out capital here and capital there and capital there to bail out these non-productive uses. And they're taking out all these liabilities in the economy instead of using them for innovation or using them for productive uses. And this slows down growth. It avoids a systemic crash. But what it does is it slows down the economy dramatically over time. That is the cycle we're in. That's the structure of the economy, the paradigm they're part of. And what's interesting is it doesn't matter at this point how they govern. The economy is going to slow down dramatically over time, no matter what they do. You could have a cyclical bounce back if they went, crazy on stimulus for a little while, but you're going to have a structural slowdown over time to very, very low levels of growth, simply because the nature of the system ensures that the blob's going to be gobbling up all the problem areas. There's going to be a lot of problem areas, and therefore capital is going to go to the wrong places, and you're not going to be growing the economy. You're going to be slowing it down.
And so there's two ways to bail out banks. Number one, create an entity that buys their bad assets. Number two is inject capital into the bank via equity. Are you saying that both ways are the blob and it actually doesn't matter?
Of course.
Yeah, which way is the Chinese government going to do both, or is it going to rely on one more than the other?
It's going to use both at different times. I mean, so what happened in the last group of asset management companies? If you go through the history of asset management companies in China, they gobbled up the liabilities for the banks. So, the banks are better, and then the asset management companies became cauldrons of garbage, and they had to be they had to be bailed out by somebody else. There's always a bigger fish bailing out the smaller fish, but guess who the ultimate fish is? It's the blob. So sitting behind, you can create 15 shells between this, but essentially all an asset management company is the government's, arm gobbling up liabilities from a government bank. So this is just one giant scheme of shifting around liabilities around the economy. It's not only is it not growth creating, but the simple fact that you're shifting them around sucks up capital and sucks up some negative sentiment. So you're actually further slowing things down. Again, what does it allow you? Why do they like it? Why do they do it? Because it avoids a systemic crash. It could threaten the economy and therefore take down the party. But the downside is you can't get out of this cycle. It's the blob or nothing.
And where does the money come from to buy these bad assets? Let's say, Huarong Asset Management, or an asset management company that's formed by the government to buy it. Does the central bank just print that money into existence, or does the government have to borrow it through the bond market, or is it come from savers, or all combination? Like, where does the bailout money come from?
Well, I mean, you can create the money. You have enormous Forex reserves. You have even more Forex reserves inside the banking system. So, with a surplus country like China, you've got no shortage of capital. So they have the ability to generate financial firepower through several different ways. But ultimately, is it going to be enough for all the liabilities they've got? No. So they've got to act like that the goal is not for the blob to gobble everything up. So it has to be stage managed in a way where it looks like you're running your economy in a reasonable fashion, and the central government has relatively few liabilities Now, I love people who constantly, quote the idea that the debt to GDP in China is very low, and then they're like, what about local governments? What about the corporate sector? Because those are all backstopped by the blob. What's real debt to GDP? So it's interesting, but people who want to invest in China, who have a particular view of their macroeconomy, they'll convince themselves that things look better than they are. It's unfortunate.
So you wouldn't touch Chinese property bonds or property companies with the 20-foot pole. You wouldn't touch bank stocks either, correct?
Correct.
Other Chinese companies, do you see any potential long-term investment opportunities? We get it. The Chinese stock market could rally for a month, for 2 months, like it did in the fall of 2022. Especially a renowned hedge fund manager goes on another program and is waxing poetically bullish about the Chinese stock market. But in terms of long-term investments in China, the battery firms, the electrical vehicle firms that are growing their earnings and their profits and their revenues tremendously as they just dominate the rest of the world's producers. A few companies come to mind. I won't name them now. Do you see investment opportunities in them or no? Why?
Yeah. Well, let me just say first off that I have never invested in Chinese equities, and I never will invest in Chinese equities because one, for a lot of reasons, but also because I don't want to be I don't want to be conflicted out of anything that I'm talking about. I want to be able to talk about this stuff and have absolutely no skin in the game, because I don't want it to be like most of Wall Street and just talking my book up or down based on whether I like the stuff and whether I hold it. So this is not about me. But if you're talking about sort of an independent advisor trying to figure out what to buy, look, right now, I mean, Tepper may be right in the short term. Now, keep in mind, Tepper was invested in Chinese equities all last year. I mean, go look at the 13F. He didn't just jump into Alibaba yesterday. I think it was his biggest position. So, during the worst periods last year. So, people have been waiting for this for a long time, including a lot of the people who are acting like they're jumping into it right away. But Tepper may be right on this. On this being, a phenomenal period for a Chinese stock surge. It certainly looks like that right off the bat. You could have 1 month, 2 months of this. I just think that people who think that this has cured the ills of the stock market are going to be very rudely awakened. There are still significant problems with investing in Chinese equities that are not cured by a government put, and that government put may not exist for very long. So I would be very careful. In terms of seeing this as more than a 1 or maybe 2 month opportunity, I'd be very surprised if we're, in the second quarter of next year and we're talking about the continued, and if I'm wrong, quote me back to me. But I'd be very surprised next year if second quarter we're talking about a Chinese stock market that is, continuing to do well. And this is an opportunity for a lot of people who've been hurting for a long time to sell into strength. So a lot of things happening right now. People need to be very cautious out as they enter this fray. Thank you
for sharing your view on that. Leland, tell us about the trade war between China and the United States. And I'm talking about the tariffs and particularly restrictions on strategically important stuff such as semiconductors. How much of companies' semiconductor stocks, such as, for example, NVIDIA's, come from China? I was shocked to learn that it actually is quite high, even though there are bans or effective bans from America on NVIDIA selling advanced chips to China, that it still is kind of going on. And that's something of an open secret. Is it
hugely good? Yeah. I mean, do you have another hour to talk trade war? I mean, look,
I got as much time as you have got.
Yeah. I'll just hammer out some points here. I mean, look, yes, chip makers have enormous market share in China. One of the reasons you haven't seen export controls be strong enough or be loophole free is that chip makers spend, a lot of their time at the White House telling them, like, you can't do this. You're going to hurt our market. We're not going to be able to have money for R&D. We're going to have to fire workers. And then, it becomes a political issue. So the people who are lobbying against, these export controls are chip makers. They're not the ones for it. They're the ones who are generally against it. But look, the idea about the trade wars has two parts. First, you could have a president, come in November with an idea that we're going to have more tariffs and we're going to try to, rectify the trade surplus that China has with us, and we're going to be proactive about it. So that's one way the trade war could happen. But I think we're going to have a trade war next year, no matter who is president, no matter what their policies are, simply because of what the policies coming out of Beijing are. If you look at what's happening on trade, What's economic governance writ large? The big thing that was announced this year and then at the third plenum is new quality productive forces. And what does that mean? It means that we want to produce more, we want to export more, we want to control, technology, the whole of government effort to produce all this technology, to dominate this technology and export it all around the world. And it means that a country that has enormous goods surpluses with almost the entire planet is trying to double down on exports and have more and more and more and more. The result's going to be greater trade friction. You're already seeing that on EVs and solar and batteries. Steel is a big issue again, because even some of China's friends are putting up big tariffs against it. So we have already entered sort of the precursor to the next trade war. But I think this is going to get uglier. It might get a lot uglier next year even. I actually have no idea what the Chinese think of either President Trump or Vice President Harris. I think that I think they are starting to come to the realization that things are going to be really there's no going back. That things can ease up and you can have areas of emphasis for one president or another, but you're never going to go back to the old way of doing things. One of the things that just absolutely shocked me was that there was still a belief, it seemed, in Beijing when President Biden got elected, that he was going to rip back everything President Trump did and give him much more warmer welcome. That just shows that they don't spend enough time in America anymore, because there was a terrible misreading of what's going to happen. And I think it's a misreading of what's going to happen in the future. So you're going to have tough policies go forward. Now, whether they're gaming this out and say, look, Trump might give us higher tariffs, but we'll have room to negotiate on something geopolitically with him. Or, maybe if we get a bunch of guys in there who aren't focused as much on a comprehensive program of export controls and investment restrictions, and we just focus on tariffs, then maybe that's painful in the short term, but it's ultimately better for us. I'm sure they're sitting noodling around on this, but I don't know what they think. And quite frankly, until we know who's going to staff the Trump administration or the Harris administration, whoever's elected in November, we're not going to really know, because a lot of this is going to have to do with what personalities are put in there. I think a Vice President Harris will mostly continue what President Biden has been doing. President Trump, it could go several different ways. This could be mostly about tariffs. It could be a comprehensive program against China. I think it'll depend a lot on who runs China policy in a Trump administration if he's elected.
So America is the consumer of last resort for the entire world. China is the producer of last resort for the entire world. So typically, America has more of a knock-on effect on the rest of the world. If America goes into a recession, it is bad for a lot of producers because we're buying less of them. So China going into a recession or slowing down might have less of an impact. But if it is producing all of this stuff, all these goods and advanced goods, stuff that European companies make and American companies make, how much deflationary pressure and really economic pain is China going to export? For example, if it's making extremely cheap electric vehicles, we're seeing the headlines about Volkswagen having issues because China is flooding the markets. How much deflationary pressure do you think China is going to export to the rest of the world?
Well, they're going to export deflation. They already are in certain sectors. But the issue is less that they're exporting deflation and more that they are so uber competitive on price, mostly because their stuff was developed in a protectionist, subsidized cocoon for years before released at scale to the world, that you have the potential to wipe out entire industries. So it's not about whether an EV comes over here or a battery comes over here and the Chinese could beat it by 15%. If that were all that was happening, then it might be this great sort of race to better technology. But the problem is that what happened in EVs. Let's take that as an example.
Electric vehicles. Yep.
10 years, China spent enormous sums with subsidizing producers, subsidizing consumers, subsidizing battery firms, keeping a protectionist wall around other firms going in there. They couldn't go in at all. Then they had to go in with a joint venture. And so having this really protective cocoon, which I call it, to develop a robust EV industry. Around 2018, they start liberalizing it. What's happening in China? Well, they produced so many firms, and so many firms are producing so many cars that there's a price war. There's a flushing out of nearly all the firms that are now losers in there. They can't compete. But what they've developed is a world-class industry that is enormously impressive in terms of technology and is and is done at a cost that is significantly below what the Europeans or the Americans or anybody else can compete with. So now let loose on the world, the Chinese have too many. The domestic demand has been mostly saturated. They're exporting a lot of the stuff to the world, particularly the firms that are starting to go out of business right now. And what do you have? You have this problem where you've got EVs going all over the place. These really impressive cars, really impressive technology at unbelievable prices. I mean, you have one of the models, BYD's models, the Seagull is under $10,000 in China, and it's being marketed in Europe at around 20,000. And this is technology is way better than what Europe's doing at nearly double the price. And so these Chinese cars are going everywhere and swamping industries. The problem is not that you're going to have more Chinese cars, although there is a data security issue, which you have to watch too. But it's that they're so good and there's so many of them that there's no way that for instance, America's car companies are going to be able to compete at this point. So it's a really tough issue because you put up tariffs to keep them out. Are you lessening the competitive pressures on domestic car companies to get it right, to get it cheaper, to get it better? Yeah, you are. On the other hand, you don't want to wipe out your car company. So we're dealing with a lot of really tough issues in that. But you just look to solar, and solar, they produce so much solar that they've overproduced. China's more in China. It's more produced in China than the entire world needs right now. And so how can you exist as a solar company outside China? How can you exist as a battery company? There's no easy answer on this, but there is a problem because the Chinese economic model, as we see it now, is now doubling down on its old model, which was already doubling down on exports. And it's really competitive, really high technology, really top-notch stuff.
How big is the push, Leland, for Chinese consumers to buy Chinese goods? Are companies, non-Chinese companies that sell in China, are they basically screwed? Tesla does have a big market share in China. Are they going to encounter increasing pressure? Is LVMH, Louis Vuitton, luxury Western European luxury items that's sold in China, very popular amongst the Chinese elite? Are they screwed as well because there's a push in China to buy Chinese?
I don't think the pressure is the old way they used to do it is that Chinese goods were inferior, but then they get mad at someone, the United States or Europe somewhere, and then they'd engineer sort of a boycott of Western goods and give all these CEOs a heart attack. When you have consumers shifting now, it's because Chinese goods are as good or better than what the foreign goods are on the ground. So I mean, one of the reasons that fewer Chinese are opting for Teslas because the Chinese options are so incredibly good. So it's a different dynamic now. Now, that doesn't mean that as geopolitical tensions increase, as we get closer to a trade war, Chinese government lacks leverage points. And one of the leverage points it does maintain is the ability to cause havoc in China for foreign companies. And so I think it will use that lever. Certainly, Calvin Klein's feeling it right now. For some slightly different reasons, but look, the whole thing is that if you're operating in China, you've got two problems. One, a lot of Chinese goods, which used to not be very good, are quite good now, and so they can beat you straight up. But also, you've got a bias for people to buy Chinese now. There's some nationalism, and the government has the ability to shut you down if they don't like you. So there's a lot of obstacles in terms of operating in China right now that companies are dealing with that they didn't think they had to worry about 5-10 years ago.
Thank you, Leland. My final question for you is about a chart. I'm sure you have encountered. I've had it from the Financial Times, but the data is reported from Preqin. It's about the number of Chinese startups that are founded. It peaked in 2018. 51,000 companies started in 2018. In 2024, so far, only 260 companies. Not even 1,000. 260. So 50,000 to 260. To me, that is incredibly ominous. Number one, why is this happening? Why is this not a terrifying chart? What can explain it? Or is it just that the China Beige book has data and that this data is wrong, and that people should check out China Beige book?
Well, people should always check out China Beige book, but the reason the chart's wrong is because the chart's wrong. I mean, there maybe if you're talking about the small nucleus of VC startups very specifically, then some of those numbers make sense. But in terms of, I think people were interpreting that to be company startups writ large registrations, and that's off by a factor of like 20,000 or something. So, I mean, that it's a chart could be useful if it reflects only like very specific VC firms type thing, and then maybe it's correct. If it's in the broader universe of companies, it's massively wrong. So I took a look at that and scratched my head and sort of moved on because it didn't make much sense to me. But I overwhelmingly right now there are pressures in starting a company, and if you're in the VC world, you got particular problems. So I don't doubt the trend. I just don't think the chart's right.
Got it. So yeah, the data is from pre-Quinn, reports for private equity companies and venture capital firms. So it makes sense that Western funded or venture capital funded startups, maybe that data is accurate, but it's not like in that only 260 companies, people are still starting restaurants with Chinese bank credit money or savings, and that is not captured in that chart. Leland, it was so great having you here. Could you just briefly summarize why you don't think this is a Mario Draghi moment in China?
Well, this is the reason not a Draghi moment is that there are two different dynamics playing out right now. And one has to do with what's happening in asset markets, and one has to do with what's happening in the macroeconomy. If you look at asset markets specifically, the Chinese have looked at the stock market and said buy. So there looks like there's a short-term put, a lot of excitement around that. They're going to backstop everyone going in. They're encouraging everyone. So stocks are looking good in the short term. The macroeconomy is a very different matter. It's uncorrelated to the stock market. And what we're seeing there is a message that we're going to step in, we're going to set a floor, but we're not reaching for a higher ceiling. What we want to make sure is we're stabilizing things, and we're making sure we don't allow this doom loop of confidence to take down sentiment and create a death spiral for the consumer, for the investor, for the property market, for everything, for equities, et cetera. So very different dynamics happening right now in terms of the stock market, which is looking really good, and I think the macroeconomy, which people, which may have a little bit of boost in the short term, but people are overemphasizing what the policies are actually going to do.
Thank you, Leland, for this interview. I was lucky enough to read some of your reports from China Beige Book, which that is your handle on Twitter. People should check that out. And number one, I want to say just how great the reports are, and they were your daily dispatches. There were only 2 pages, which you have enough information and analysis to fit 10 pages. But so often people do write 10 pages, and it's just a little bit too much for me and for clients. So I just want to give a shout out there. Could you just tell people, number one, the meaning of China Beige Book based off of the Federal Reserve report, and what services and data do you provide, and why it's meaningful?
Yeah, China Beige Book, the name came from the Federal Reserve, which does their own beige book. And we figured when we were challenging the idea that inquiries in China, data collection in China wasn't being done very well, we could do something better. We looked at a bunch of models, say maybe we should look at the Beige Book model. And so we started something modeled on what the Federal Reserve does for the United States. On China, it was partly quantitative, partly qualitative, and we got into it. And what we realized very early on is that the qualitative stuff, which is what the Beige Book in the U.S. does, was interesting, but the quantitative stuff was magic. Because in the United States, you don't need that quantitative stuff in the Beige Book because there's a billion different data points in the United States. You already got all that. So the Beige Book adds qualitative flavor. That's its shtick. For the China Beige Book, we were dealing in an opaque black box economy. No quantitative data was really available except what the government provided, and people were realizing that stuff was nonsense. So we started saying, wait a second, forget this qualitative stuff. It's nice flavoring, but the magic is in the quantitative data. So we focused on that. We said, what do we think we can collect? Let's get it bigger and bigger and bigger and bigger and broader and ask more interesting questions, and not focus on developing one number. So we don't want to put out like a 5.5% GDP growth for China or a 51.2 in the PMI. We develop suites of metrics across I think 100,000 dimensions or something. And we track not only growth, but we track the labor market, we track inflation, and importantly, we track credit and shadow credit. So we understand what firms are paying for capital, how often they're borrowing, what is this capital used for, and if you get those, you can put together a composite of China from the ground up, and that's what makes this really interesting. Not that China is a number, a singular number. You've got a lot of different Chinas inside China. You got to make sure you're understanding the dynamics across all the regions, all the sectors, all the different types of firms, private and state, and put it all together into something that people can digest and understand.
People should check out your work at China Beige Book. Leland, we are recording this the afternoon of Friday, September 27th. The Chinese stock market is up. I think the best week for the Chinese stock market since 2008. And I read online that the 52-week low in the Chinese stock market was 2 weeks ago, and the 52-week high is today. So it just shows how rapidly the fortunes have changed in the Chinese stock market. We're definitely, because we're going to release this as soon as possible. This is happening quickly. We're going to release this on Sunday over the weekend, so people can get informed as soon as possible. But the week after, are you predicting, or are you sensing that there will be more news flow, more policies, or do you think the bazooka, if it is a bazooka from the People's Bank of China and the Chinese Communist Party, is over?
No, I think they have to keep trickling out some specificity, particularly on the consumer side. They announce this stuff. They're not going to just not do it. Some of the stuff they may not do, but I think they have to start trickling some stuff out next week. You're going to see some big bond issuance numbers. Where that's all going, maybe we don't know. Maybe we'll never know. But they'll talk about some of it going towards the consumer. Others there'll be recapitalizing the banks, and the banks will be doing more lending, and firms will be getting it. So you're going to be getting more information, and it's all going to be sort of positive. But we may not get the specificity we want, next week or maybe ever.
Leland, thank you again for coming on. Thank you, everyone, for watching. Remember that Monetary Matters comes out regularly on Sundays and Wednesdays. We may tweak that if there's an emergency scenario, do an extra episode. So stay tuned for future episodes with bond master convexity maven Harley Bassman, as well as the brilliant macro mind Lynn Alden. And remember that this show is on YouTube, Apple Podcasts, and Spotify. Will include links to everything in the description, as well as to Leland Miller's service, China Beige Book. Leland, thank you again for coming on. Thank you, everyone, for watching.
Thank you, Jack.
Thank you. This closes the door.